What's going on, ladies and gentlemen? Today we are going to shoot through a fun video where we're going to talk about how I go through a company to determine whether it is worthy of my money. I don't have many companies that I like in the stock market, but every once in a while a company becomes attractive to me to the point where it garners my attention. So here we are. We're going to go through a company and all the little points that I look at to determine whether or not it's worthy of my dollars. So here I have my Excel sheet where I have a bunch of companies that I look at from time to time, and we're just going to go through the whole list of how I study a business. So here we have Adobe. Why are we looking at Adobe? Because they recently had earnings and they just came down to this nice level right here. So on a PE ratio, they came down from this 35, 37, this high level that they were at, and they came down to this 28 level. So now it's garnering my attention because I like Adobe, but I just didn't like it at those high valuations. But now that it's come down, it's time to look into it and see if we got a potential winner here. Now, the first question I ask myself, and I ask myself this on every company, is do I understand the business? Do I know the business? Do I understand how they make money? And if I can't answer that question in 5 seconds, then right there, my conviction for that company drops to almost non-existent. Because if I can't understand basics of how they make money, if I can't wrap my mind around that, then I'm not going to know when it's time to bail, when it's time to sell, when it's time to get rid of the company. Because I don't just sell a company because it goes up or down. I sell a company because of something fundamentally that I believe has changed with the business in the real world. So this is why I stay away from pharmaceuticals, things like that. Adobe, I understand it. I get it. They sell software for creatives, for making digital art. Adobe pretty much has a monopoly on digital art. Now, you may think that AI is going to take over and ruin their business, but I don't believe that's the case. I think that they are going to be a beneficiary from AI in the long run. So enough with that. Let's look at the fundamentals. Here we have Adobe. It's looking like they're going to be growing earnings at double digits, 12%, 13%, 14% through 2026. And now we're at this 28 PE level, which sounds about right. So the stock could easily be back up here at this 600 level in like a year or two. That's why Adobe is now interesting to me. Now let's go into my Excel spreadsheet. Now this Excel spreadsheet is where I put all my businesses that I look at, because there's so much going on with so many different businesses that it's hard to keep track. This makes sure that I don't miss some metrics or something to look at. Now, it looks like a lot, but really there's only a few things that I care deeply about. So I want to see everything, but I weigh 2 things, 3 things with like 80-90% of the weighting of how my decision making. So Adobe right here, that's the ticker. Then we go with buybacks. Do they do buybacks? That's the first question I ask myself. Because if a company is doing buybacks, that's something I love, something I want to know. So Adobe does do buybacks. So we're going to put a Y there for yes. Now, IO is insider ownership. This is something new that I've added. That's why it's not fully filled out. And the insider ownership for Adobe is not over 5%. So I wrote a little note here. It says insider ownership over 5%. If that's the case, then I'll put a Y. Adobe, not the case. So we're going to put N, no. Next question. What's the market cap? How big is this company? I want to see it in my brain. I want to see the size. I want to compare it to all these other businesses. All right, visualize everything. $216 billion. Okay, net income for 2026. So what's their expected net income going to be for 2026? And to look at that, I have Market Screener, and I look at this income statement evolution. This is based off the analyst 2026. Net income is $8.2 billion. So then we go ahead and we just put that in. $8.2 billion. Boom. So 216 divided by 8.2. We're at 26.34. It's funny how these companies all converge around this 26 number. This was another reason I like this company now, is because before this recent drop in the stock, the stock was at this, like, what is this? 600. Now we're at 480. So 480, we're adding like 500. So we're adding $100 on 500. That's 20% more. Okay, so this number, this 216, was 20% higher. This is something I like to think about. 216 times 1.2. We were at 260 billion. So before this recent drop, when you do this math, it was 260 divided by 8.2. They were at 31. So this number was at 31 before the earnings. So that's something interesting that I like to see. And so now that it's at this 26 level, it's much more appetizing. Because now when I go to buy a Leap, the odds that it's going to go against me in the next 6 months, 12 months is much lower than when this number was at 31 times 2026 net income. So our target for this ratio is we want under 26. None of these things need to happen guaranteed for me to pull the trigger on a company, but they are things that I need to know and be aware of. So now we got one of the main metrics I look at. And I might, if I'm doing a quick analysis on a company, I'm on the go on my phone, and I just want to see something really quick, this is something I will look at right away, which is called the rule of 40. This number to add up to 40, which is the revenue growth plus the operating margins. And I love this metric because it combines the different realities of one side. You have businesses that are growing really fast and don't have good operating margins because they're growing really fast. They're investing all their money. And then on the other side, you might have a business that's pretty well defined, pretty mature, and has great operating margins, but their revenue growth might be much slower. But as long as they equal 40, then both businesses could still be good. Because you could have a business that's doing 40% revenue growth and 0% in operating margin. That's not the end of the world because they're doing 40% revenue growth. So as long as that's okay, it's okay for them to not necessarily have operating margin. Then on the other side, you might have a company that's doing 0 growth, but they're doing 40% operating margin. So they have a lot of money that they can return back to shareholders. Now, obviously, we want some growth, but that's why I love this ratio. And it's something you can do quick, 2 seconds. You just look at the income statement, you can see this information. So revenue growth year over year. Let's look at Adobe. So let's look at annual. Let's just do annual. So we're doing 19.4 minus 17.6, 1.8. Okay, so 1.8 billion divided by our 19.4. So we're growing at 9% from 2022. Now, let's just write that in for now, right? But we're going to skip over to operating margin. So operating margin for this last quarter, operating income, 907. So we're going to do 907 divided by 5,182. 17.5%. See, this is why I haven't been in Adobe. On top of their crazy valuation that they had. Now it's not as crazy, but a company growing 9% with operating margin only at 17, that's not going to give us our rule of 40. We're not hitting 40. We're nowhere near 26.5. Like, bruh. But what's interesting about Adobe is when you look at this market screen, right, up here, the growth that we're expected to have. So let's just do some hypotheticals here. So 2023, 19.4 billion. We're going to 21.4 billion. What growth is that? Again, that's 10%. Yeah, dude, we're doing this 10% growth in revenue, but margins are supposed to expand. Like, where do they spend all their money, dude? Why are your margins so terrible? And this was my biggest worry. And the telltale sign was this right here. Insider ownership is less than 5%. When I asked my little AI, it said right here, insider ownership for Adobe, 0.37%. That's nothing. You have 448 million shares outstanding, and the insiders only own 1.65 million. That means that they get paid their stock-based compensation, and then they dump the stock. And then that leads to them constantly having to do more putting out more shares. Don't like that. Look at this. Look at this. Spent $1 billion. Earnings growth. I'm gonna put 13%. Forward P 17.97. Yeah, I don't like how much money they spend on SG&A. 620 divided by percent. They must have bought something. What did they do here? They did something, man. This number should be higher. Should be 1.9. 36. And we would be over 40. What did they buy? No wonder their stock went down. That's why their stock went down. This is when we dig deeper. Where's my investor relations? Oh, it's at the bottom probably. What? That's terrible. They had to pay $1 billion for the termination of the Figma transaction. So that's what the problem was. So let's assume that that's not going to happen every quarter. That's crazy. That sucks. Well, that makes this a lot better. So we can make that green now. See, growing at 9%, but having operating margins at 36%, I'm chilling. It's fine. Well over that 40 level. And then we're at a market cap of 26. And we're doing buybacks. We're good. Now, buybacks, we're 25 billion through 2028, 11% outstanding shares. So we're going to shrink the outstanding shares while growing revenue 10% and while growing margins. That's huge. Why couldn't they buy Figma? Dude, I'm telling you, the FTC is out of control. Regulatory objections, concerns over competition in the design software market. Bro, they are out of control. That's crazy. So now they have to do they're going to make Figma like internally, I believe, or what I heard. Innovation and competition in the market. Dude, they should go public. If they were going to get bought at 20 billion, dude, they're probably so pissed. Oh, dude, they were going to get rich. That's crazy. Wow. That's why the stock dropped. They spent $1 billion. Dang. They really thought they were getting that. That's crazy. Adobe really might be the one we can trade on. We're going to say 1.9. We're going to disregard the Figma 41. Like, they're in the ballpark for all these numbers. We're growing. No dividend. We don't like dividends. Thank God. Price to sales times sales. Revenue growth divided by. See, my little note here. More useful with pre-earnings biz. Target 0.25 or lower pre-earnings biz. So, like, less mature, growing. But once it's a growing, mature business, it's okay for it to be higher. So, 1 or lower. So, but the main thing I'm looking at is this right here, rule of 40. And that comes down to operating margins, the revenue growth. Second main thing I look at, the buybacks. And how significant is the buybacks. The fact that they're going to buy back 11% of their stock, the entire outstanding stock, means that your ownership of your stock between now and 20, you're going to grow by 11%. Your ownership of the entire earnings of the entire company will grow by 11% regardless of what the business does. So when you multiply that with the revenue growth and with the margin expansion, that equals money in your pocket. That equals stock go up. And then you look at where we're trading at right here. This is reasonable. When you look at where it normally is at, okay, I mean, I don't put too much credence on fast graphs analysis, but it does put things in perspective for you. Wow, that Figma thing is crazy, though, to think about. Anyways, that's Adobe for you. That's what I look at. This is what I study. And hope you find it helpful. Hope you found it entertaining. Make sure you like. Make sure you subscribe. Stay tuned for the next one. Peace.